So a question for you, Jeff, as you're working with this, and folks are probably familiar with notices. We're going to go through some common types that we're doing. We've talked before when you started at the IRS, which you say when you started, it was 2010. So 2010 when they started cutting the budget. Can you speak to what the workforce was as far as the reduction in force and the kind of the reliance as you were a revenue officer? Did you see automated notices and see that they had a stack when you look into their transcripts that they have 35 notices before they ever came to your desk, to kind of speak to the prevalence of the IRS cutbacks as well as, notices ballooning?
Sure, I can do that, no problem. So yes, when I first joined the IRS, that's when the budget cuts began. Before I got there, as a revenue officer, the revenue officer corps, if you would call them, I don't know a better word, there were approximately 10,000 revenue officers throughout the United States. And their job was to go out, collect the money, collect missing returns, what have you. By the time I left in 2017, there were approximately 3,400 revenue officers left. So you can see there was a significant drop as far as headcount, and therefore that really impacted case selection and the ability to do one's job, because then it became a matter of which case do we work versus which case do we put off to the side because we just don't have enough people. And as far as the notices, that's a great observation, Jeff. I wouldn't really recognize on the transcripts the amount of notices, although they're there. I would see that in the field when I'd go knock on a door and the taxpayer would tell me, well, I didn't know I had a tax problem. I never received anything. And you'd kind of glance inside the door frame and you'd see a stack of letters from the IRS that had never been opened. It was quite humorous. Unfortunately, it was kind of also sad because I was there for a reason, and at that point, it was the end of the line for most folks as far as having to have an easier solution than dealing with me. So that's one of the examples.
Yeah, well, and it makes sense because you're running into, and we'll talk more about this, I'm sure, but people are really terrified when they get anything from the IRS, unless they're expecting their refund. That's the only time they're glad to hear from the IRS. And so in talking with practitioners and working with people that are responding to notices, they bring in the fourth one where they're starting to get nervous and none of them are opened. So, and we'll talk about prevention and some ways to intervene early, but the IRS is taking this as just a hammer that keeps pounding away and keeps sending the notices and assessing penalties and doing these other things. But this is, you're seeing, if you look at the IRS stats book, you're seeing realistically hundreds of millions of notices going out every year. Because it's not revenue officers knocking on your door anymore. We can do that with, machines and postage stamps. So, yep. All right. Well, with that, we'll pass it back to Jeff to continue on with the presentation. We'll ask you some questions a little later on as well.
Okay. So in this case, we're going to talk about a few different notices, what we feel like are some of the most common notices, and give you some examples and basically talk through them a little bit. So the first one that we're going to talk about is the CP 2000. And if you talk to any practitioner who's ever dealt with a notice, the first thing that comes to their lips is the CP 2000. It's so common and regular that everyone knows it. But for those who have never worked in resolution or are new to the tax arena, the CP 2000 is basically the IRS saying the income or payment information that has been reported to us from third parties doesn't match the tax return information. So you've reported your income. The IRS gets all this information from other groups such as your employer, your banks, credit card companies, what have you. And when it doesn't add up, they send out the CP 2000. The next one is the LT 11, or it's also known as the Final Notice in Demand, or FND 1058. And the difference between those two is it depends on where it comes from. The LT11, which is a final notice in demand, comes from the automated system saying that it is now time to pay or we are going to take actual action. The FND, or final notice in demand 1058, will come from a revenue officer. So that's really the distinction. That's the only difference. They say the exact same thing, they have the exact same effect, and they require the exact same action. So in this case, the LT11 is basically notification by the IRS that they have not received any money or payment for overdue taxes. And this is the last letter before they begin actual enforcement action, whether it's seizing property, levying bank accounts, whatever the case may be, levying your paycheck. So this is kind of the end of the line, and things are getting serious at this point with that. The last one we're going to talk about is the CP 523, and that's the intent to terminate an installment agreement and levy assets. And that's a pretty common one because at this day and age, the IRS has made it fairly efficient and easy to enter into a payment plan. The problem is for most folks is being able to stay in that payment plan due to missed payments or non-filing or various things that could impact your ability to remain in that agreement. So let's break each one of those down. So let's start with the CP 2000. As I mentioned, the information on file doesn't match. And as I said earlier, the IRS gets information from just a bevy of different sources, whether it's your employer, if you are self-employed, a Schedule C filer, then anyone that has paid for your services should be sending you a 1099. They also send a copy to the IRS. If you accept credit cards or PayPal, if you sell on Amazon, all that information is sent to the IRS, and they have it in their systems, and they will take that information and compare it to what you've claimed on your return. Also, for another example, is if you invest, your stock purchases and sales will also be reported, which would impact your personal return. In many cases, not only will there be a change to the income, but there's also a potential of credits and deductions that you've claimed being changed. Let me give you a story. I'll give you an example. So I helped a young man who has just graduated from a school here locally, and what happened was he did not report a $1,500 grant from the school he was attending. Now, of course, there's different types of grants. Some are taxable, some are not. In this particular case, the $1,500 was a taxable grant that he didn't realize he needed to report. So the school sent in the 1099, and of course, his income that he reported was about $1,500 short of what the system had. So they sent a CP 2000. What's interesting is when he contacted me, he stated the IRS wanted to charge him $1,500 in tax for the $1,500 of income. Obviously, we live in a society that doesn't charge 100% tax rate. I mean, I don't know anyone who's ever paid that high of a rate. I think in the 30s is about as high as it's going to get these days. But anyway, the reason why he was so confused and why it looked like it was a $1,500 tax is the IRS had reversed his American Opportunity Credit, and they did not believe he was a student, even though the $1,500 was a grant to go to school. Figure that one out. So basically what we did is we had to not only take a look at, confirming that the $1,500 was the correct additional income, but we also had to prove that he was a student so we could make sure that he could retain the American Opportunity Credit. So it's not just a matter of addressing the potential other income in this case, but also any other changes the IRS is attempting to make to the notice based upon the other aspects of the filing. So how do you address this? And what did we do? Well, first and foremost, you have to research, right, and determine what happened. Working with your client, explain the situation, coming to an agreement, and understanding what transpired, and then coming up with a game plan to address it. Once you do, you're going to want to generate a letter. And in many cases, some notices will include a response form. Generally speaking, I like to also include a letter so I can clearly explain the situation and what has transpired, as opposed to just checking a box or writing in a couple of numbers. The next thing that letter should do is should help clear up the situation, explain what has happened, and make it very simple for the IRS to understand why they are wrong and why it needs to, they need to look at and agree upon your position. And then in some cases, you may have to pay extra. So the young man that came to me, he ended up owing a tax bill of about $150, and he ended up having to pay that. It's not a big deal, but it is what it is. So those are kind of the steps to resolving the CP 2000, is certainly addressing it, sending that letter, explaining your position, and then if necessary, paying extra, or at least, potentially getting a refund if things don't match up. The next one, the LT11, as we talked about, the final notice and demand. And if you recall, this is the one where there's been no payment for overdue taxes, and this is the end of the line where the IRS is getting ready to make a huge impact on your client's life. So keep in mind, though, that this LT11 is not the first letter to be received by your client. This letter comes after a huge amount of notices were received previously. The key to this notice, though, is the word final versus the prior words that were included, probably like possible. We could possibly levy this. We could possibly seize this. Whereas this is final demand. We're not messing around. So chances are your client previously received the CP 501, a CP 503, a CP 504, and as they've ignored those prior three, they have now received the LT11 or the final notice and demand. Whatever the case may be, it's the final. They all sound threatening, all these CPs, but the action truly starts with this particular letter. So how do you address this? Well, when your client receives this letter, they're also given legal rights. And in this particular case, they're given 30 days to file what's known as a collection due process, or CDP. It's a very powerful appeal against enforcement action. And what that means is the collection due process, you are able to state your case in front of appeals, make the arguments to avoid the enforcement, discuss potential outcomes and resolutions. And what's interesting is with the collection due process, if appeals sides with the IRS and says, no, we don't agree with your position, you actually can file and take this to tax court. So that's where this is so powerful, is generally speaking, the appeals department tends to be independent and consider all aspects and variables in one's case. But again, if they don't agree, you have the next level up, which is the U.S. tax court. But let's say because your client tends to miss deadlines and forget about things, and that 30 days comes and goes. Well, you may not be able to file a collection due process, but you can file what's known as the request for an equivalency hearing, or an EH. And that is also a meeting with appeals. However, it does not allow for tax court rights. But that equivalency hearing can be filed within the first year of receiving this letter. So if it's been 9 months and your client has woefully missed the 30-day deadline, you still can actually request an equivalency hearing with the appeals department. Keep in mind, this is important because, once again, this letter is the last step before action. Generally speaking, when I was a revenue officer and I would send this letter out, I would put a reminder on my calendar that the 31st day was the day to issue the levy. So again, when you receive this, the IRS is no longer messing around. So when you talk to appeals, how does that work and what happens there? Well, with that, we talk about remedies or potential remedies. And what you can speak to them about is collection alternatives. So if you think about this, how can we resolve this issue without having your client suffer the hardship of a levy on their bank account or wages, or having their assets seized by a revenue officer? Well, when you go to appeals, they're going to give you the opportunity to request various alternatives. And you do that through another form that's included with the 1058 or letter 11, and that's the form 12153. And that is the formal request for a collection due process hearing. And on that form, it's going to say, well, How do you want to resolve this? What options, do you want to express and try and get to? And on those remedies, it will include potentially an installment agreement, offer and compromise, currently not collectible, or also you may want to file bankruptcy. Who knows? But of those, you certainly need to express what option you are seeking, why you're seeking it, and then provide the appropriate documentation to support your position. So, for example, those that have been in resolution, they know if it's an installment agreement or offer and compromise or currently not collectible due to hardship, you're going to have to provide some financial documentation to prove those steps and those claims. So as you can tell, just from this brief description, this is going to take more than 3 hours, as I previously mentioned, as far as the length of time it takes to deal with a notice. So be prepared for that. But certainly it is a position that you need to be prepared and ready for, because it is so important for your client to avoid the enforcement action taken by the IRS. And the third one is the CP 523. And again, this is the intent to terminate the installment agreement and levy assets. And basically what this means is that your client previously got an installment agreement, was going along, and then somehow didn't do what they were supposed to do. There are various reasons why they get kicked out. One could be inaccurate information during the request for the installment agreement. If they claim to have made only a certain amount of money and they left out a bit from maybe a third party or from another source, and the IRS finds out about it, that gives them the ability to kick them out of the installment agreement. Or if their request doesn't meet the terms of the agreement, they have that ability to also kick them out. But really the most prominent factor that comes into play when it comes to terminating an installment agreement is failure. Failure to pay their monthly bill, failure to pay another tax liability after the installment agreement was granted, failure to provide information upon request, failure to pay the modified amount. So you can see where I'm going with this. Basically, what usually happens with installment agreements is the taxpayer did something, had some sort of hiccup, which basically caused them to no longer meet the agreed upon terms of the agreement. Most of the time, it's probably a missed payment, or they incurred a new tax liability due to subsequent years on their tax returns. So in this particular case, it's going to be the intent to terminate an installment agreement, which then would lead to default. And so the question might be, well, what is default versus termination? So the proposed termination is called a default. So you have a 30-day window to address the issue. So it's a process, and for most people, they would almost use termination and default interchangeably. But in this case, again, the proposed termination is called a default. So in this case, the taxpayer is in default. They have not met the terms, but the IRS gives them a 30-day window to address the issue. That means either getting current with missed payments, filing a missing return, paying that balance that they incurred from a different year, or they also have that 30-day window to file what's known as a collection appeal request, or a CAP. And this, again, is a situation where you would go in front of the appeals department or division and speak to why your client should not have their installment agreement terminated. The nice thing is that during this 30-day window, there's no enforcement. The IRS is not legally allowed to start taking any assets or levying any assets, not while there's the opportunity to either correct the mistakes or discuss with appeals the situation at hand. But if for some reason appeals does not agree, or that 30-day window comes and goes and your client hasn't rectified the situation, then no longer is your client in default. Now the installment agreement has been terminated. So that basically is the overview of the CP 523.